So how much does financial advice really cost? Well, in this video, I'm going to actually go over what are the costs for financial advice that you could be getting right now. Okay, so right off the bat, I'm just going to say that I do not believe that financial advisors are evil people, okay? Even though they can be very expensive, that's what I want to go over today is like really, how are those costs? How much does it really cost? And how do you know which financial advice is good and which is not? That's what I'm going to cover in this video today, and be sure to stick to the end because there are some big key things that so many people miss when they're looking to pay for a financial advisor. All right, so first and foremost, what do financial advisors cost? Now, this can vary greatly. There's usually about two different formats what a financial advisor will do. First, there are financial advisors that are commission-based only. They're commission financial advisors. These are the people that actually get paid off the products or the plans that you implement with them. So for example, if you decide to buy any kind of insurance and their insurance license, they'll get paid on the insurance. If you decide to buy into a mutual fund, they get paid on that. And many of them get paid off of the commissions that will come off it. It could be annuities, it could be whatever it might be. And so maybe you're not paying out of pocket for this kind of advice. However, you kind of are too, if you understand what I mean. Because remember, to a hammer, everything looks like a nail, right? To a financial advisor, when they start giving you that advice, if they are commission only, whether they like it or not, and I know because I worked as this kind of this commission-based financial advisor for 4 years, is that whether they know it or not, still you're subconsciously affected by what do I get paid. So I'll give you an example. When I would give people different financial advice and different options with mutual funds and whatnot, you know, the one mutual fund that would pay me almost nothing was a money market. If they put into a money market account, there was like a fraction of a percent that you would get paid on for that kind of advice. And so even though I would often give people that advice, I would still tell them to go there. There was always a part of me that said, Chris, you're getting paid diddly squat for putting people's money in this place. And so I would make sure that they're diversified into other things as well. And of course, you know, based on a financial advisor's advice that they give, yes, you should be diversified, yada, yada, right? But I was still looking for, okay, what are these other things? Are there fee structures? You know, is it upfront fees that you're paid on? Are you paid on the back end? Are you paid like in the middle along the way? There's all these like A, B, or C shares that are involved when it comes to mutual funds. And I'm trying not to get too much in the weeds here, but just so you know, there are a variety of different ways that a financial advisor gets paid. And if they're commission-based, they understand these things. I'll give you another little trick, or I should say like almost a slimy trick that sometimes financial advisors will use, especially those that are insurance licensed. I remember when I was working with financial advisors, one of them was doing a training. He says, guys, look at this. If you don't put $500,000 as the death benefit, but you put $499,000 as the death benefit, your payments, your commissions actually go up a little bit. You actually get paid more on a little bit less insurance than you would more. So just be aware, you could actually make more money if you just give them $499,000 instead of $500,000. Now, if you really dig into this, why was the insurance agent getting paid more for doing less insurance? Because there was a cost break there for you as the client. So if you did $500,000 of insurance, well, that actually reduced your fees. So when you paid that, you know, even if it's term insurance, right? If it's term insurance, $500,000 could actually be cheaper than $490,000 of insurance because they give you a little cost break for doing higher insurance. Same thing at $1 million. They give you a little cost break there. Maybe they have a cost break at $250,000 or $100,000. There's all these little cost break areas that if a financial advisor or an insurance agent knows about, and if they use it to their benefit and not yours, you could actually be paying more money to them. Because remember, insurance agents only get paid off of the insurance cost. They get paid a percentage of that. So many times they're not incentivized to give you the best deal because they want to do what's best for themselves. I've seen this especially true when I talk about whole life insurance a lot on this channel, and you'll hear me talk about it a lot. But insurance agents are paid off those commissions. And so sometimes, even though they could give you a better deal, they might go somewhere in the middle. They might say, well, it's not the best for the client, but it's not the worst either. But, you know, I at least, you know, maybe I'll just go slightly under the best so that I still get paid a little bit more while they still get a good enough deal. And you want to be aware of that. You do not want to fall prey to those kind of strategies and tactics. So just be aware that when you deal with a commission-only insurance agent or financial advisor where they're paid off the products they recommend, you may not be getting the best deal. Just like if they do an annuity and they throw all these bells and whistles, well, maybe that annuity pays a bigger bonus to the agent, and that's why they're going with that specific company versus giving you the one that may be better for your situation. So be aware of that. So in my opinion, The one that you should be the most wary of is the commission-only advisor. Now, the next one is a fee-based advisor. Now, fee-based can be good, but they can also not be so good, right? Fee-based advisor will say they'll charge you one fee and that's it. They'll give you the advice. They tend to try to stay away from the products as much. Sometimes there's a combination. Maybe they get paid on the products a little bit. Maybe they get paid on the fees. But fee-based usually are focused more on just charging you for that particular type of plan, and then that's it, right? So you could do whatever you want. You could be investing in different things, and that could be the best thing, just to make sure that they give you more, I wouldn't say non-biased advice, but closer to non-biased advice based on what might be best for you. They don't care because honestly, they're getting their fee, whether you do it or not, right? They're getting their fee for creating the plan. Now, in my opinion, this could be one of the best ways to go about it. Even our company, even though we're not investment advisors, we charge a fee for that very purpose because we don't want to get paid from whatever investments you do. When we're helping you find and connect and do certain deals, we want to stand apart from that. And so I know for our benefit, we charge a consulting fee for our clients so that you can actually have real non-biased advice. Now, when I say that, of course, I still have a bias. I still have preferences. I still have opinions, of course, and so does every other financial advisor that's out there doing that kind of thing. But be aware that when you're dealing with a fee-based advisor, because they get paid their fee, you also need to make sure they deliver. If they don't deliver for you, the fee doesn't matter. Because remember, I think it's kind of criminal that somebody gets paid whether you make money or not. Which leads to the next one, that's really a third option I'll give you, kind of as a bonus here. The third option, it's kind of like the commission, but it's not exactly the same. And that one's called assets under management, or AUM. Many financial advisors, when they're talking to each other, they'll talk about how they have X amount of dollars AUM, right? And that's assets under management. How much money do they have that they're managing for their clients? Now, they will usually get paid, the typical fee is like right around 1%, right? 1% a year. For example, if you have $100,000, they're getting paid $1,000 a year. Now, if you have $1 million, you're getting paid $10,000 a year. Understand this, that if you have a lot more assets, you're probably going to get more attention. If you have less assets, you'll probably get less. This is why some brokers will refuse to work with people that don't have at least $250,000, $500,000 that they're going to invest with them. Now, you have to be aware of this. You have to be very wary because assets under management, even though they just get paid a flat fee for whatever it might be, and it could be more or less than that 1%, the one issue you might run into is that if the market goes down, if you lose money, they still get paid, right? So much like the fee-based advisor, they still get paid. Now they do have an incentive because the more money you have with them, the more they get paid, right? So they, of course, don't want you to lose money, but just so you know, when you lose money, they still make money, right? I was talking with a client recently. He said, I'm looking at different options. He's like, our current advisor charges us 1.36% on our money. This couple had about $750,000 with them. So that's about $10,000 a year they're being charged. I told him, I said, the funny thing is, even if you hire us for fee-based, we're like one time up front and then very cheap on the back end. You would actually save money after just a couple of years alone. And we probably would make you more money than what you would make with those guys. But anyways, so they were saying like, yeah, we're paying them about $10,000 a year for our money. But we have another advisor that's just charging 1%, so we pay them about $7,500 a year. I said, well, that's great, but remember, if the market drops 20%, you go from $750,000 down to $600,000, they're still getting paid $6,000 a year. And the truth is, when you get these advisors, whether they're doing assets under management, there's a few that might be actively involved in your money, but for the most part, they're usually just throwing you into certain funds, and they're just as much at the mercy of the market as you are. They have no clue what's going to work. They don't know what's going on. They can even try to guess where to put you, but in many times they're often wrong. And so you're lucky even to get market performance. Now, if you happen to get even better than the stock market performance, great. But remember, even when you lose money, they still are making money off of you all the time. And those fees are coming out. And remember too, because if you had that same guy, right? If he goes from $750,000 down to $600,000, and then $6,000 comes out, now you're left with $594,000. If the market goes down again, you lose more money, and then they take more money out. They're still taking the money out of that account. You want to make sure that you're always making money. So just be aware, even though they have your assets under management, and that's kind of the standard way you see as advice out there, you got to be very, very careful not to be the one that gets duped, right? Not to be the one that's just paying somebody to really do something you could be doing yourself and not have to pay that stupid fee. So my recommendation is, between those three types, I prefer the fee-based, but you want to make sure somebody has a great track record. And here's the other thing too, guys. With the assets under management and even sometimes with the fee-based, remember, to a hammer, everything looks like a nail. When they know that they only get paid on you putting money in the stock market, that is a dangerous place, because then they're saying, no, I only get paid here, that's why I'm gonna have you put your money here. Fee-based is better because they'll say, yeah, you can go do real estate investing, you can go do this or that. That's good. But remember, if they're so hung up on the stock market is the thing, they're not really giving you a diversified approach to what could actually give you greater wealth now and in the future, because they don't have that full perspective. So if you go with a fee-based person, make sure they have a good full perspective. And here's a bonus tip for you guys. I like fee-based advisors that actually have been there, done that, and still doing it today. In fact, I like fee-based advisors that don't even need the money from you. They have enough money coming in from their own investments that they could retire and quit today. That's the kind of advice you want to go for. So guys, I welcome you. Subscribe to our channel. If you like this video, comment, give us your thoughts. What are some things you like about financial advisors? And I would say this, guys, follow for more videos, because we give a lot more advice about other areas you can invest outside of the stock market that could possibly help you retire decades earlier than what you would do with these other advisors. Go check that out right now.